Over the past few years, something unusual has been happening in the US stock market. By nearly every traditional valuation metric, stocks appear to be more expensive than ever before. In some cases, valuations are not just above average, but higher than at almost any point outside of major bubbles. Due to these high valuations, many experts, such as Michael Burry, the man who accurately predicted the 2008 financial crisis, have been sounding the alarms on market bubbles for years now. And yet, markets continue to hover near all-time highs. So the obvious question is why? Are stocks genuinely overvalued, or are the old benchmarks no longer relevant for some reason? In this video, I want to step back from the media's headlines about a market bubble that are supposed to instill emotion and fear, and look at some of the causes for these higher than average valuations. Before we jump into the video, I want to note I am not a financial advisor, and this is not financial advice, and I'm not trying to make this some kind of prediction video. Rather, I want to focus on some data analysis for educational purposes. Before we can talk about why US stock market valuations are high, we need to be clear on what I mean by valuation in the first place. At its core, valuation is simply a comparison between the price investors are paying and the return that they are expecting to get. There are several different valuation metrics. The most familiar metric is the price to earnings ratio, or PE. This measures how much investors are willing to pay for $1 of reported earnings. For example, if a company reports earnings of $5 per share, then a PE of 20 would mean investors are paying $100 for a share in the company. When the PE is high, it means investors are paying a higher premium to own shares of the company, usually because they expect stronger future growth in that company. And the opposite holds true, where a low PE means investors are paying a smaller premium for a share in the company, usually because they're expecting that company to have slower growth. This is why faster growing companies like Apple or Google are trading at higher PEs of roughly 35, while companies that aren't really able to grow much faster, usually retail or telecommunications companies like Verizon, are trading at PEs in the low teens or even high single digits. Another popular valuation metric that is used to look at the valuation of the market as a whole is the so-called Buffett indicator, which the famous investor Warren Buffett popularized. It just simply compares the total market cap of the US stock market to the US GDP. Historically, this indicator has been high in times of stock bubbles, like in 2000 and 2007, where stocks were overvalued across the board, and it's been low in times of recession when stocks were seen as undervalued. But currently, it is at all-time highs, and have been hitting all-time highs for a few years now, which furthers the idea that some believe the stock market to be overvalued. A couple other valuation metrics are price to sales, Q ratio, free cash flow yield, various versions of PE ratios like trailing or forward PE, or trend lines. What makes the current environment notable is not just that one of these metrics is elevated, but that all of them are elevated simultaneously across the board relative to their historical baselines. And they have been for years now. So either we're in one of the longest bubbles in history, or there is something fundamentally different about investing nowadays. Let's talk about that. To understand one of the most important factors behind today's valuations, it helps to rewind the clock back to Warren Buffett's early investing years. Back in the 1960s, the US stock market existed, but it was not something most people actively participated in. Investing was slow, expensive, and operationally complex. For the average American, their main source of information about stock prices was the newspaper, and they could only place trades through a broker on the telephone that charged them a very large commission. Most savings flowed into bank deposits, pensions, or government bonds, and international investors faced regulatory and logistical barriers that made US stocks very difficult to access. In that environment, capital was scarcer. Fewer dollars were competing for each share of corporate ownership. When Warren Buffett talked about buying wonderful businesses at fair prices, those fair prices existed in a market where participation was largely limited to institutions and the upper classes of society. For the average American household, owning stocks was not the norm, it was the exception. Additionally, foreign countries had a much harder time investing in the US stock market. Fast forward to today, the landscape is almost unrecognizable. Purchasing shares of companies has never been easier and cheaper, with most brokerages offering zero commission fees. Additionally, information about markets has never been more readily available than it is now. As a result, the percentage of society participating in the stock market nowadays is the largest it's ever been. In 1962, less than 20% of American households owned stocks, compared to almost 60% in 2022, and this number is only continuing to increase. The SEC has published a dataset showing the amount of US households that own stocks. Since 1989, there has been a 157% increase, while the United States households only grew by 40% in the same time. This means that in 1989, only 32% of households held stock, while in 2022, that number was at 58%, with the trend looking like it will only increase. The SEC has also listed the main value of the household stock value, adjusted for inflation, and we see that has increased over 250% between 1989 and 2022. We can multiply this number by the number of households holding stock to get a good estimate of the value of stocks held by US households over time, which we see has had an 815% increase over the last 3 decades, showing yet another change that is causing more cash to flow into the stock market. Another major factor is that it's now easier than ever before for citizens in foreign countries to invest in the US stock market. Since 1974, there's been an almost 7,000% increase in the value of US stocks held by foreigners, and this is adjusted for inflation. This trend is likely to increase as the world continues to become more globalized. Taken together, we have seen that there's just a higher percentage of society and the world that is now accessing the US stock market, meaning that systematically, more money is competing for the same assets, so valuations are expected to be higher nowadays compared to the past. Now, these changes in the stock market has not only been driven by globalization and improvements to technology, but there's also been a structural change in society that enabled it. Prior to 1981, for US workers, the norm was a defined benefit pension. In this pension plan, the company carries the risk. Your employer promises you a retirement paycheck based on your time at the company. If the markets crash or people live longer, the company still owes the checks. Because of that, defined benefit pension managers don't just invest for growth, they invest with one goal. They need to make the future payments reliably. They do this by matching assets to liabilities, usually resulting in bond-heavy portfolios. In the early 80s, the 401k was introduced, a retirement savings plan where individuals get good tax incentives to save and build wealth for retirement in this account. This made defined contribution pensions, the kind where the individual carries the risk, much more feasible for the average American, since they could routinely invest part of their paycheck into the stock market, and over several decades, compounding growth would accumulate massive retirement wealth. Here's why this matters for markets and valuations. Defined contribution plans create a steady, automatic pipeline of money that flows into the stock market. Every paycheck, every month, on repeat, with most of that money flowing into the stock market via mutual funds or ETFs. If we look at what percentage of the private sector's employees use defined contribution versus defined benefit, we see a clear shift in the early 80s, around when the 401k was introduced. However, this dataset is just the US private sector employees. For a different comparison, let's look at the share of total asset value for defined benefit and contribution pensions. And although DC pensions share isn't as large here, the overall trend is still the same. Defined contribution pensions have been greatly increasing in popularity for a few decades now. And this trend is continuing to grow, meaning that the amount of wealth being routinely funneled into the market is only growing larger. The outcome of society shifting away from employer pensions to personal retirement accounts is a structural change where new cash is now routinely flowing into the stock market, creating a persistent structural demand for stocks that just wasn't present before the 80s. Now, let's compute some statistics to see if these factors are actually causing valuations to increase. To do this, we will do what's called a Granger causality test. This is a statistical hypothesis test that will tell us if a time series is actually useful in forecasting another. Here's how it works. Let's call the dataset we want to predict Y. In this case, that's the valuation metric, and the predictor time series will be called X. In our case, that will be the factors previously shown. First, an autoregressive model is built for y using only lagging values of y's past. This will be used as a baseline. Then a new model is created where we try to predict y with the past y values plus the x values with the same time lag. If this second model predicts statistically significantly better than the first, we can say that x is helping to predict y. I should note that this test does not outright prove that x is 100% definitely causing y, as they may share a third factor that drives them both, but it will tell us if x does help predict y, beyond what y's own past already predicts. Running this test for some of the previously mentioned factors against the average PE of the US stock market, we find an interesting trend. For foreign-owned assets, time lag values between 2 and 5 years gives us a statistically significant result, while for household stock value, this only happens for lag values between 2 and 4 years. And although this might not be the best way to compare it, I thought it would be fun to use the changing share of DC pension plans as a factor as well, and it too gives a significant result between lag values of 2 and 4 years. This means that these factors have statistically significant predictive power in these time windows. So since there are lag values that make their predictive power significant, we could say that the factors mentioned here are part of what's driving higher valuations in the stock market. However, the range of lag values that gives us these statistically significant results are quite similar across the factors analyzed here, and that would likely mean that there's another shared factor that is influencing all of them. This is quite common with stock market analysis, where there are just simply too many factors to account for in order to make an accurate prediction model for the stock market. And as mentioned at the start of the video, this is not meant to be a prediction video, rather I wanted to focus on education, so take these results with a grain of salt. And there we have it, some of the systemic changes in the stock market that could be causing traditional valuation metrics to appear overvalued. The gist of it is that a higher percentage of society is now participating in the stock market than in the past, largely due to changing retirement plans and greatly improved accessibility. So nowadays, there's just more money competing for stocks, which could be driving up valuations compared to the past. In any case, let me know in the comments what you think, and I hope you were able to learn something from this video. Until next time.